All right, here is the video for the review for accounting 3303 exam number 2, which is going to cover things like budgeting, activity-based costing, and standard costing. Okay. Um, Now, this first group of problems comes from, I believe it was the fall 2022 um, exam 2 that I sent out to you. Okay, so I'm going to skip to the problems. You can look up the multiple choice. So number 31, Lubriderm Corporation has the following budgeted unit sales for the next 6-month period. There were 30,000 units in finished inventory at the beginning of June. Plans are to have an inventory of finished products equal 20% of unit sales for the next month. 5 pounds of materials are required for each unit produced. Each pound of material costs $8. Inventory levels for materials are equal to 30% of the needs for the next month. Materials inventory on June 1st was 15,000 pounds. Prepare the production. So part 1 is prepare the production budget for July, August, and September, and given the total purchase, and then part 2 will be the purchases budget. All right, so the production budget, we simply have July, August, September, October, and I'm going to go out here to November because I don't need it for the production budget. I do need it for the purchases budget. All right. Okay, so July is 120,000, 210,000. This is just sales that I'm copying from up above. 150,000, 180,000 in October, and November is 120,000. All right. Now, in the problem, you had up here there were 30,000 units of finished goods inventory in June. We don't need that, right? Because July is going to be our starting month that we want for the production budget. So that's just that 30,000 is just a red herring for that. Okay. And be careful of this, because one of the things students do is if a student has information, they try to fit it in. But part of this is knowing what you need and what you don't need. So now we need the desired ending inventory, and that'll be 20% of the next month's sales. So 20% of 210 is 42,000. 20% of 150 would be 30,000. 20% of 180 would be 36,000. And 20% of 120 would be 24,000. Okay, so this gives you your total needs. You don't have to do this line if you don't want to. I like to, but you don't have to. All right, so that's our total needs. Then we have to subtract off the beginning inventory. Now that'll be 20% of this is 24,000. And this will be our production. Okay, now we can just move these down this way, right? 20% of 210 is the 42,000. 20% of 150 is the 30 that we calculated earlier. And 36,000, we move that over here. And we just add those up, or subtract them off, if you will. All right, So that's our production budget. We are done with A, right? So this, this, and this. All right. So now we need the purchases budget. So with the purchases budget, we are told we need 5 pounds of materials are required for each unit produced. So I'm going to just bring the production down here. And I'm going to multiply everything by 5. Okay. Um, we get 700,000, so we need 700,000 pounds of materials to produce the 140, right? We need 990,000 pounds for August. 780,000 pounds in September. 840,000. Okay, now that we have it in pounds, it is exactly what we did before, except our materials are 30%. The material inventory, or yeah, pounds of material is 30% of what the needs for next month. Okay, so 30% of 990 is 297,000 pounds. 30% of 780 and 252,000. Okay, so once again, you don't need to add this together. I do, so that just kind of keeps me in line on this stuff. So 1,032. Okay, so this is our needs. This is our ending inventory. And we then subtract off the beginning inventory. So 30% of 700,000 would be 210,000. So we need to purchase 787 pounds. Now we can just move these down like we did before, 297, 234, and subtract them off. Um, Okay, so this is our purchases in pounds. So this is part B here. And then it tells us that each pound of material costs $8, and they want our purchases in dollars. So we just take the 787 times 8. 927 times 8, 798 times 8. $6,384,000. $7,416,000. $6,296,000. All right. So that is a purchases budget and a production budget. Okay. The next one we have is a cash collections. We have Duppy Corporation has prepared the following sales budget. And we have cash sales and credit sales. Collections are, and when I say collections are 40% in the month of sale, they mean 40% of the credit collections, 45% in the month following sale, 10% 2 months following sale, 5% are uncollectible. Prepare a schedule of cash collections July through September. Okay, so we need July up here, August, and September. Then in May, we'll sell May, we'll collect in June, and we'll collect in July. So we need May's credit sales. And that will be 68,000. And that will be 10%. So May we collect 40%, June we collect 45%, in July we collect 10%. So that'll be 6,800, and we are done collecting May's credit sales. Then in June, we've got June's credit sales. June's credit sales is 80,000. So we'll collect 40% in June and 45% in July. And that will be 36,000. And then we will collect 10% in August. So that's 8,000. And we're done. Now, July comes along. We've got July cash we will collect. And July cash is 18,000. But we don't collect cash anytime except the month we sell it. Then we have July credit is 74,000. So 74,000 times 40% is 29,600. $45 in August will be 33,300, and then 10% in September will be 7,400. Okay, then we go to August cash. The August cash is going to be 24,000. None will get collected in July, but we get 24,000, and none of the cash of August gets collected in September. Then we go to August credit. And so in July, we don't collect any of that, but in August, and August credit was 92,000. So we collect 40% of that in August. Is 36,800. And 45% will be collected in September, is going to be 41,400. And now we come down to September cash that won't be collected in July or August. Be collected in July or August. And so, but we will collect 22,000 in September, right? And then we have September credit, and that's going to be 76,000, and we collect 40% of that is 30,400. Now we simply add those up. So we get 90,400 in July. I get 102, 100. That's right. And then September. And so that's our cash collections for the month. All right, the next problem. The president of the company, Peter Francis, has come to you for help. Use the following data to prepare a flexible budget for possible sales production levels at 1,000 or 10,000, 15,000 and 20,000. Show the contribution margin at each activity level. Okay, so we're going to have 10,000, 15,000. Now this is where we're making a flexible budget before the fact, right? And the reason we do a flexible budget before the fact is so that, as things are going along, we have benchmarks to see how we're doing. Oh, we sold this many. Here's what our expenses should be. So our sales should be. So our sales is $30 a unit. So that would be 300,000 there, 450,000 there, and 600,000 there. Underline these. So not trying to add them together. Then we'd have our variable costs, which would be manufacturing. Would be $10 a unit, so that would be 100,000, 150,000, and 200,000. Then we would have the administrative, these variable costs. Not sure what administrative costs would be variable, but we'll go with it. It's 30,000, 45,000, and 60,000. Finally, we have selling, and that'll be $1 per unit, so 10,000, 15,000, and 20,000. All right, so now we get the contribution margin, which is one of the things that they ask us to include. 300 minus 140 would be 160,000. 450 minus 210 would be 240,000, and 600 minus 280 would be 320,000 for our contribution margin. All right, then we get our fixed costs. Manufacturing is 70,000, and that's all the way across. All right, that doesn't change. And then administrative would be 30,000, or a total of 100,000. And then we just subtract that off. That would be 60,000. That would be 140,000, and that would be 220,000, like that. All right, so that's a flexible budget before the fact with contribution margin. Okay, the last one from this group. The SkyTalk Company manufactures weather vanes. The 2020 operating budget is based on production of 5,300 weather vanes, with 1.25 machine hours allowed per weather vane. Variable manufacturing overhead is anticipated to be 145,750. Actual production for 2020 was 5,250, so we were 50 less, using 6,050 machine hours. Actual variable costs were $21 per machine hour. And it doesn't tell us what it wants us to do. So, let's assume that they want us to do the variable overhead variances, right? So the overhead is anticipated to be 145,750. And we will divide that by 5,300. Gives us 2,750 per weather vane, and divide that by 1.25, and we get $22. So now our flexible budget is going to be, the standard is going to be 1.25 times 22, and remember we built 5,250 of these. We actually used 6,050 machine hours, and that would be times the 22, the standard, right? So this is the standard quantity of hours times the standard rate. This is the standard rate. This is the actual quantity of hours here. And then over here we have the actual quantity times the actual rate. So we have 6,050 times 2175. So we get 131,587.50 was what we actually spent. we should have spent 133 100 given that we use that many hours, and the standard would have been 144 375. And so now we calculate our efficiency variance. That will be 11,275 favorable. And this is our rate or spending variance, depending on who you use. $1,512 and 50 cents, and that is also favorable. All right, so that's that test. Let's take a look at the next one. This one is accounting 30. The heading is accounting 3303, exam number 2. So there's some multiple choice and some true false there. I'll let you go through and figure those out. Okay, so then we get to the problems. Kramer Enterprises reports year-end information for 2015 as follows: sales, cost of goods sold. Kramer is developing the 2016 budget. In 2016, the company would like to increase selling prices by 12.5%, and as a result, expects a decrease in sales volume of 10%. All other operating expenses are expected to remain constant. Assume that cost of goods sold is a variable cost and that operating expenses are a fixed cost. Okay. So what we need to do, the first thing we need to do, because it's asking us what's our budgeted sales for 2016. So the first thing we need to do is get this 960,000 and divide that by the 160,000 units. And we get that this was 960 divided by 160. That's going to be $6 per year. That was our sales price, right? Now, we are expecting sales volume, a decrease in sales volume of 10%. So instead of 160, we are going to sell 90% of that. So it would be 144,000 units, but we get a 6%, or sorry, it was $6, but we're going to get 1.125, 12% increase. So now that'll be $675 will be our new selling price times the 144,000. So we'll get 972 will be our new sales. So an increase of $12,000. Then what is the budgeted cost of goods sold? So now we take the 640,000 and we're going to divide that by 160,000 units. So our cost of goods sold was $4 a piece, and we multiply that times the 144,000, and we're going to get 576,000 for the cost of goods sold. All right, 2 and 3. Demesio Valley Orchards developed standard costs for direct materials and direct labor. 2015 DVO estimated the following standard costs for one of their most well-loved product, the DVO Classic Grandma's Large Apple Pie, which had a brown sugar coating on top of the crust, as well as including cranberry and mince ingredients in addition to the apples. Direct materials, 2 pounds at $6.25 per pound, and direct labor was 0.2 hours at $13 per hour. During September, DVO produced and sold 1,100 pies using 22,300 pounds of direct materials at an average cost per pound of $6 and 200 direct labor hours, an average wage rate of $13.20. Okay, so let's start. We've got the materials. Okay, so material price variance is going to be the actual. So that was 2,300 times average cost of $6 per pound. $13,800. Now we use 2,300 pounds, and the standard was $6.25. Be 14,375 minus 13,800. That'll be 575, and that'll be favorable, right? So the price variance is 575 favorable. Don't forget the favorable or unfavorable. The question is not complete without that. Okay, then we have the efficiency variance. So this is going to be 1,100 times 2 times 625 over here. Oops. Is 13,750. And that will be 625 unfavorable. Okay. Labor. Okay. We use 200 direct labor hours and an average wage rate of $13.25. That'll be $26.50. Okay, we use 200 hours. Our standard wage rate is $13 per hour. That'll be 2,600. So this is going to be 50 unfavorable. And then the labor efficiency variance, we cooked 1,100 pies times 0.2 hours times $13 an hour. $28.60. And And so our efficiency variance is 260 favorable. Okay. Number 545, Zitric Corporation manufactured 90,000 buckets in February. The variable overhead allocation base is $5.05 per machine hour. The following variable overhead data pertain to February. The actual was $5.15 per hour, and the actual machine hours was 9,800. And so we got 50,000 for 70 as the actual variable overhead. The flexible budget amount, well, this one's easy because the actual and the budget were the same units. And so all we have to do is take the 9,000 hours times the 5.05, and we get 45,450 for that. Okay, so we've got the two on the ends. We need to calculate the middle. And so the middle is going to be 9,800 hours times the budget of $5.05, or the allocation rate. $49,490. Okay, so the spending variance would be this minus this. Remember, this is our middle number up here. And so 49,490, enter. Will be 980 unfavorable. The middle number is lower, so it's unfavorable. And the efficiency variance will be the 45,450 minus the 49,490 will be 4,040, also unfavorable. Okay, so that's that one. The next one, Quindo Table Company manufactures tables for schools. In 2015, the budget is based on sales of 44,000 units at $55 per table. Budgeted variable costs are $35 per unit, while fixed costs total $660,000. Actual income for 2015 was a surprising $477,000 on actual sales of 46,000 units at $57 a piece. Actual variable costs were $33 per unit, and fixed costs were $627,000. Prepare a variance analysis report with both flexible and sales volume budgets. All right. So we've got our actual budget. We can just start filling in blanks here. The actual units sold was 46,000, and the flexible budget is 46,000. Our static budget was 44,000. Okay, and then our sales was 46,000 times $57 is 2,622,000. The flexible budget would be the 46,000 times 55, 2,530,000. And then the static sales would have been 44,000 times 55 per unit is 2,420,000 there. Okay, then our variable costs were 46,000 times $33, 1,518,000. On the flexible budget, it was supposed to be 35, so it would be 46,000 times 35 would be 1,610,000. And then on the static budget would be 44,000 times 35, 1,540,000. So the contribution margin is just one minus the other, right? So sales minus variable costs. So 2 million. $1,104,000. The flexible budget would have been 920,000, and then the static budget $880,000. Then our fixed costs should be the same. The flexible budget and the static budget would be the same. Fixed cost is 660,000. And total fixed costs were 627,000. Then we need our operating income. $447,000. $260,000 for the flexible budget. And 220,000. Now all we have to do is fill in the variances. And so the actual and the flexible budget, there is no variance on units sold. The volume variance here is 2,000 favorable. All right, so this is not an expense, right? This is a sale, so we want the actual to be bigger than the static budget, so that's favorable. And the same is going to be true with sales. It's going to be backwards of expenses. And so our sales here would be 110,000 favorable, and here it is $92,000 favorable, right? And that's all due. This one is all due to selling for $2 more. Now our costs. And so this will be 92,000 favorable, This will be 70,000. Unfavorable. Sorry, put that wrong. 70,000 unfavorable. Contribution margin. This is much like sales, right? We want bigger, not less. Okay, so we've got $184,000 favorable, and this will be 40,000 favorable. This will be 33,000 favorable, and operating income $187,000 favorable, and 40,000 favorable. All right, so that's that one. Different management levels and banks requiring varied degrees of managerial accounting information. Because of the need to comply with managers' requests, 4 different variances for manufacturing overhead are computed each month. The information for September overhead expenditures is as follows. The budgeted output in units was 3,200. The budgeted fixed manufacturing overhead was 20,000. Oh, 20,000. Oh, I had 60 in my head. 20,000. Budgeted variable manufacturing, $4 per direct labor hour. Budgeted direct manufacturing labor hours, 2 hours per unit. So our actual units manufactured was 3,400. 3,400. 3,400. All right, and 3,200. Okay. And we had variable overhead incurred, 35,600. The input direct manufacturing hours was 7,200. And that would be $5 per hour. Is 36,000. And let's see, we had 3,400 times 2 would be 6,800 times 5 is 34,000. Okay, so the efficiency variance was 2,000 unfavorable. Not really a variance here. And here we had 400 favorable. The fixed overhead, 26,000. So we had 6,000 unfavorable there. Okay, the production variance. Okay, so actual output. So we had so that would be 3,400. So we have 20,000 divided by so that would be fixed overhead would be $3.13 per hour. 2 times would be 625 times 21,250, and so this would be 1,250 favorable. All right. Yeah, you're not going to see that. Okay, the next one. This looks like we want to do a cash budget. So this one's pretty intense here. So we want to know that we have a beginning balance in October of 10,000. So we need to do sales and disbursements. Month of sale is 30%, month following sale is 50%, 2 months following sale is 15%. Okay, and we want October, November, and December collections. So we need 2 months before, so we need to start with August. So in August, we had sales of 34,000. We're going to collect 15% of that. In October, $5,100. And we won't collect any in November or December. Then in September, we are selling 38,000. And we're going to collect 50% in October. So that'll be 19,000. And in November, we're going to collect 10% of that, 15% of that. That's 5,700. None will be collected in December. Then in October, we're going to have 42,000 in sales. We'll collect 30% of that. Will be 12,600. And then we'll collect 50% of that, which will be 21,000 in November. And we'll collect 15%, is 6,300 in December. And we're done. Then in November, we'll collect none of that in October. We have 48,000 times 30%, 14,400, and then 50% or 24,000 in December. And then finally, December, we don't collect any in October or November, but we do have 60,000. If we collect 30% is 18,000. Now we just add these all up. This will be 48,300. 41,100 in November, and 36,700 in October. Now let me check my math just to make sure before we go on. $36,700 is right. $41,100 is right. $48,300. Okay, so those are right. All right, so we have our beginning. Yeah, well, this one is. I already did the total cash collections. So August would be 5,100, 1,900, 12,600, nothing. Total cash collections is 36,700. We have nothing for August. We have 5,700, 21,000, 14,400, and nothing. In December, we've got that and that. 6,300, 24,000, 18,000, 48,300, and 41,100. All right. So now we need to do the purchases. Okay, so 40% are paid in the month of purchase, and 60%, the rest, is paid the following month. So from September, 14,000 times 60% is 8,400, and we're done. In October, we've got 16,000. That will be 6,400. Yeah, 9,600, and we're done. Then in November, we won't pay any of that there. November is 18,000, 7,200. And 10,800, and then December would be 20,000. 40% of that is 8,000. All right, so our total cash payments 14,800, 16,800, and 18,800. So our change in cash will be 36,700. 14,800 minus is 21,900. The change in cash is 41,100 is 24,300, and the change of cash for December 48,300 is 29,500. So that's our change in cash. So our ending cash balance will be the beginning balance plus the 21,900 would be 31,900. That'll be our beginning balance up here. $31,000 plus 24 is 56,200. And so this will be 56,200 plus 29,500. 85,700. Company has 50,000 principal loan balance and needs to repay it, but also needs a $10,000 minimum balance. What is the earliest it can be repaid? That will be December. Right? Because if they paid it in November, they would go below the 10,000. All right, so that's that one. That's an hour into it. Let's stop there for a minute, and I'll come back and do part 2 with the other two.